When you earn about $50,000 as a freelancer, you might face roughly $7,065 in self-employment tax, compared to employees whose tax experience is different. Here's where this could catch you off guard. If you don't pay your quarterly estimated taxes, the IRS could hit you with penalties. Many freelancers aren't aware that not paying throughout the year can lead to extra charges. It's not just about the initial tax, but about managing it on time. Today, we'll explore the impact of missing those quarterly deadlines and how you can avoid penalties by understanding when and how much you're supposed to pay, making tax time less stressful and more predictable. Disclaimer: this video is for general education only, not tax, legal, or financial advice, and every figure is a 2026 estimate. For your own situation, always check with a licensed tax professional. So, why do freelancers need to make these quarterly payments? The IRS expects you to pay taxes as you earn income. Since you're self-employed, there's no employer withholding taxes from your paycheck, which means you're responsible for regularly paying 15.3% for Social Security and Medicare taxes. If you wait until the end of the year, not only could you face a hefty tax bill all at once, but also a potential penalty for late payments. This system helps spread your tax burden over the year, avoiding financial stress at tax time. For many, setting aside roughly 25 to 30% of your income can cover both federal income and self-employment taxes, giving you peace of mind and control over your finances. If you miss the quarterly payment deadlines, the IRS may impose an underpayment penalty. Essentially, this penalty is calculated as interest on the amount you didn't pay throughout the year. For instance, if your total tax liability is about $10,000 and only half has been paid by year end, you're likely to incur an additional charge, potentially as extra as 2 to 3% of the unpaid amount. This penalty varies based on how much was unpaid and how much time has gone by since the payment was due. Understanding this system allows you to make sure you're budgeting for taxes and staying on top of quarterly payments to avoid surprise fees down the line. How does the IRS actually calculate this penalty, you might be wondering? It's based on how much you've underpaid by each quarter and how long those funds have been overdue. The IRS looks at the missed payments as not having loaned them the money throughout the year and charges you interest as a late fee. Think of it like a credit card. The longer you take to pay, the more interest you accrue. However, you can reduce this risk by adjusting your tax payments if your income fluctuates. If your income unexpectedly spikes, aim to update your estimated payments accordingly to stay ahead of any potential charges. Let's bring this to life with an example. Suppose you're a freelancer earning $50,000 in 2026. Here's how the numbers look. You owe about $7,065 in self-employment tax. If you paid nothing during the year, come tax time, you'd face not only this amount but also a penalty. If the penalty is roughly 2% on the unpaid portion, that's an extra $141 just for missing payments. However, if you divided that $7,065 into 4 payments and paid roughly $1,766 each quarter, you'd avoid that penalty. Planning and regularly setting aside those amounts can keep your bottom line healthier, avoiding unpleasant surprises. Now, how can you ensure you're getting it right? Keeping track of due dates is a good start. They typically fall in April, June, September, and January of the following year. Use those dates as reminders to review your income and adjust your payments if necessary. Tools like accounting software or a dedicated tax planner can make this process smoother, ensuring your records are accurate and up to date. By making it a habit to review your financial situation quarterly, much of the anxiety about missing payments or penalties can be avoided. A proactive approach helps maintain cash flow and avoid distractions from your freelance work. Sometimes, changing tax situations may require adjusting your strategies. For instance, using different ways to manage your finances through retirement accounts, like a solo 401k, can reduce your taxable income. Specifically, setting aside up to $24,500 as an employee contribution for your solo 401k can lower your adjusted gross income. For freelancers with varying incomes, such strategy might help to mitigate the tax they owe at the year's end. Consistently reviewing your income and deductions allows you to optimize and make timely quarterly tax payments, potentially lessening or avoiding penalties altogether. In summary, sticking to quarterly estimated tax payments helps prevent unnecessary stress and possible penalties. With a smart plan, you can manage your finances effectively throughout the year. Remember, setting aside about 25 to 30% of your income will cover these estimated payments and help you stay penalty-free. If you need to calculate your numbers accurately, the calculator I personally use is linked in the description. By staying organized and prepared, you can focus more on growing your freelance business and less on tax surprises. Don't forget to subscribe for more helpful money tips.